morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX Global, bringing you the morning comment for the 22nd of February. June 23rd, the date of Britain's fate. UK Prime Minister Cameron struck a deal with his European counterparts on Friday to alter the terms of the UK's membership in the European Union. The agreement includes changes to migrant welfare payments, safeguards for Britain's financial services from unwanted Eurozone regulations, and greater authority to block EU legislation. Now the battle turns to home. At Saturday's cabinet meeting, Cameron warned the support to recommend voters that Britain stays in Europe, and immediately after the two-hour gathering, he called a referendum to be held on the 23rd of June. However, London Mayor Johnson declared during the weekend that he would join the Leave campaign. A poll on the 17th of February showed that after Prime Minister Cameron, it is Johnson's opinion that counts to voters the most. The pound surged late Friday following the deal, but opened with a gap down today, weighed on by Johnson's remarks. In our view, this is likely to increase volatility in GBP even further, which could result in a choppy trading going into the vote. We believe that the currency is now likely to be sensitive to the results of the incoming referendum polls. Market participants may begin to carefully monitor the release dates of these polls, as every headline could become cause for violent swings in sterling crosses. Having said that, though, we would like to sound a note of caution on the ability of polls to predict the actual outcome of the vote, considering how poorly forecasters called the results of the latest UK election. As for today's events, during the European Day, we get the preliminary manufacturing and service sector PMI data for February from several European countries and the Eurozone as a whole. We believe that weak global demand have hurt the bloc's manufacturing and service sectors, and as a result, we expect most indices to have declined. From the US, we get the preliminary market manufacturing PMI for February. The index stands above the 50 barrier, and expectations are for a fractional rise. However, both the Philadelphia Fed and Empire State Manufacturing Indices continue to point to a contraction in February, and therefore we see the possibility for a negative surprise. Anyhow, the market generally pays more attention to the ISM index, which has been standing below the 50 mark for 4 consecutive months. We have an ECB executive board member speaking today. As for the rest of the week, on Tuesday we get the German IFO survey for February. The forecast is for all 3 indices to continue declining for the 3rd consecutive month. This would be in line with the ZW survey for February, which showed that business optimism in Eurozone's growth engine continued to be dragged down by the slowdown in China and other emerging market economies. We have no major events or indicators on Wednesday. On Thursday, the second estimate of the UK GDP for Q4 is forecast to confirm the initial estimate. However, the first estimate is compiled via the output approach, while the second one derives from the expenditure calculation. Throughout the quarter, retail sales were flat on average, while real wages have been slowing down. Therefore, we see the possibility for a downside revision. From the US, we get durable goods orders for January. Both the headline and core figures are forecast to have risen. Given that industrial production rebounded in January after falling for 3 consecutive months, a rise in durable goods seems likely as well. On Friday, Japan's CPI for January is coming out, and while no forecast is available for the headline figure, the core rate is expected to have declined to 0. Although we could see the headline CPI to tick up a bit due to energy-related base effects, a fall in the core CPI could add more pressure on the Bank of Japan to act again in the foreseeable future. In Germany, the flash CPI is forecast to have slowed to 0.1 from 0.4 previously. and decline in German inflation could indicate a slowdown in the Eurozone CPI as well, which comes out next week. From the US, we get the second estimate of GDP for Q4, which is expected to be revised down due to a weaker business spending than previously expected. Both personal income and personal spending for January are expected to have accelerated. The optimism among consumers was reflected in strong retail sales, and that's why we believe that personal spending will show a similar gain. Finally, G20 finance ministers and central bank governors will meet in Shanghai. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX Global, wishing you solid trading.